Let me tell you something that won't make me popular with the Silicon Valley crowd. Tech stocks are all overvalued, every single one of them. And I don't care if that makes me sound like a dinosaur or if people say I don't understand the future. I've been investing for over 70 years, and I know a bubble when I see one. This is a bubble. Now, before you dismiss me as some old curmudgeon who doesn't understand technology, let me be clear about what I'm saying. I'm not saying technology isn't important. I'm not saying technology companies don't create value. I'm saying that the prices people are paying for tech stocks bear no relationship to the actual value of the underlying businesses. That's what overvalued means. And when prices diverge that far from value, bad things happen to investors. I want to tell you a story that illustrates exactly what I'm talking about. It was the late 1990s, and everyone had lost their minds over internet stocks. Companies with no revenue, no profits, and no realistic business plan were being valued at billions of dollars. People were mortgaging their houses to buy more stock. Day traders were quitting their jobs to trade full time. It was mass insanity. Warren and I watched this from Omaha, and we were dumbfounded. We couldn't believe what we were seeing. People were violating every principle of sound investing, and they were being celebrated for it. Anyone who urged caution was mocked as old-fashioned. The phrase, "this time is different," was repeated so often it became a mantra. I remember sitting in my office reading about some internet company that had just gone public. The company had $20 million in revenue, was losing $50 million a year, and had a market capitalization of $5 billion. $5 billion for a company that was burning cash and had no path to profitability. The math made no sense whatsoever. But if you pointed this out, people looked at you like you were crazy. They'd say things like, "You don't understand the new economy," or "traditional metrics don't apply anymore," or "it's all about eyeballs and clicks now." It was gibberish dressed up to sound sophisticated. Warren and I refused to participate. We wouldn't buy internet stocks at those insane valuations, and we were pilloried for it. Berkshire Hathaway stock underperformed the market. We had shareholders questioning whether we'd lost our touch. Some people sold their Berkshire shares to buy more tech stocks. They thought we were fools. Then the bubble burst. Starting in March of 2000, tech stocks began to fall. And they didn't just fall a little. They cratered. The NASDAQ composite, which was full of these tech stocks, dropped by about 78% from peak to trough. Trillions of dollars of market value evaporated. Companies went bankrupt by the hundreds. Investors lost everything. People who'd made paper fortunes in 1999 were broke by 2002. Day traders who'd quit their jobs couldn't get them back. Retirees who'd bet their savings on tech stocks had to go back to work. It was a disaster that ruined countless lives. And Warren and I, we came through just fine because we hadn't bought into the nonsense. We'd stuck to our principles. We'd refused to pay prices that made no sense. We'd been willing to look foolish in the short term to avoid being fools in the long term. That experience taught me something important, though I already knew it before. Markets can stay irrational far longer than most people expect. Bubbles can inflate well past the point where they're obviously bubbles. And the crowd is usually wrong, especially when the crowd is most certain it's right. Now, here we are, over 20 years later, and I'm watching the same movie play out again. Tech stocks are once again trading at valuations that make no sense. People are once again convinced that traditional valuation methods don't apply. The same rationalizations are being trotted out. And I'm once again the old man telling everyone they're making a mistake. Let me explain exactly why tech stocks are overvalued. It comes down to a few fundamental principles that never change, no matter how much technology changes. First principle: the value of any business is the present value of all the cash it will generate over its lifetime. That's it. That's the whole game. When you buy a stock, You're buying a stream of future cash flows. The question is, how much should you pay for those cash flows? This isn't complicated mathematics. If a business is going to generate $100 million in cash over the next 10 years, you shouldn't pay more than $100 million for it today. In fact, you should pay less because money today is worth more than money tomorrow, and because there's uncertainty about whether those cash flows will actually materialize. Now, let's apply this to tech stocks. Take any of the major technology companies trading today. Look at their market capitalization. Then look at their earnings or their free cash flow. In many cases, you'll find that the stock is trading at 40 or 50 or even 100 times earnings. What does that mean? It means investors are assuming that earnings will grow dramatically for many years to come. They're assuming the company will maintain its competitive position. They're assuming no disruption, no competition, no technological obsolescence. They're assuming everything goes right for decades. That's a lot of assuming. And in my experience, when you have to make that many optimistic assumptions to justify a price, you're probably paying too much. Let me give you a concrete example. I'm not going to name specific companies because I don't want to pick fights, but let's talk about a hypothetical tech company. This company has $50 billion in revenue, earns $5 billion in profit, and has a market cap of $500 billion. That's a price to earnings ratio of 100. For that valuation to make sense, what has to happen? Earnings have to grow substantially, probably for at least a decade or more. The company has to maintain its margins, which means it has to fend off competitors. It has to avoid being disrupted by new technology. It has to navigate regulatory challenges. It has to keep attracting and retaining top talent. Everything has to go right. Now, some companies can do this. Microsoft has done it. Google has done it. But for every Microsoft and Google, there are dozens of companies that couldn't maintain their position. Remember Yahoo? Remember MySpace? Remember BlackBerry? These were dominant technology companies that fell apart when the competitive landscape shifted. Technology moves fast. Competitive advantages that seem unassailable can evaporate quickly. Today's leader can be tomorrow's has-been. And when you're paying 100 times earnings, you're not being compensated for that risk. You're assuming it away. Second principle, a company's value depends on its return on invested capital. This is something that tech enthusiasts often ignore. They focus on growth, on revenue increases, on user counts, but none of that matters if the company can't generate good returns on the capital it invests. Some tech companies have fantastic economics. They generate high returns on invested capital because they don't need much capital to grow. Software companies, for instance, can often scale without massive capital expenditure. That's genuinely valuable. But many tech companies have terrible economics. They burn through cash. They need constant infusions of capital to keep growing. They're basically running on a treadmill, spending more and more money to acquire customers who may or may not ever generate enough profit to justify the acquisition cost. I see companies that are spending billions of dollars to grow revenue by millions of dollars, and somehow the market treats this as positive. It's insane. Growing for growth's sake is not a strategy. It's a recipe for destroying capital. Warren likes to say that when a management team with a reputation for brilliance takes on a business with a reputation for bad economics, it's the reputation of the business that remains intact. The same applies to technology. Just because something involves technology doesn't mean it has good economics. Most businesses, whether they're tech or not, have mediocre economics. That's the reality. When I see a tech company trading at an astronomical valuation, I ask myself, what are the economics here? What kind of returns is this business generating on capital? In many cases, the answer is disappointing. The company is either burning cash or generating mediocre returns. Yet, investors are paying premium prices because they're extrapolating growth without thinking about the economics. Third principle, competition matters. This seems obvious, but people forget it when they fall in love with a tech stock. They see a company with a great product and assume it will dominate forever. They don't think about what happens when competitors show up. Technology markets tend to be brutally competitive. Barriers to entry are often lower than people think. A couple of smart programmers in a garage can create something that disrupts $1 billion company. That's the beauty and the terror of technology. It enables rapid change and creative destruction. When I look at tech valuations today, I see prices that assume no meaningful competition. Investors are pricing in the idea that today's leaders will remain leaders indefinitely, earning monopoly-like profits forever. That's not how it works. Competition comes, margins compress, growth slows. It's inevitable. I watched this happen in the PC industry. In the 1980s and 90s, everyone thought PC makers would print money forever. Dell was the darling of Wall Street. But then competition intensified, the product became commoditized, and margins collapsed. Dell went from hero to zero in the eyes of investors. The same thing happened in smartphones. For a while, BlackBerry dominated. Then Apple came along with the iPhone and destroyed them. Now there are dozens of smartphone makers, and except for Apple at the high end, it's mostly a low-margin commodity business. This pattern repeats over and over in technology. A company invents something new, enjoys a period of high margins and rapid growth. Then competition arrives and economics deteriorate. The early investors make money. The late investors, who bought at peak valuations, assuming the good times would last forever, lose money. Right now, we're in the phase where investors are assuming the good times will last forever. They're paying prices that only make sense if competition never materializes and margins never compress. That's wishful thinking, not analysis. Fourth principle, management quality matters enormously. This is true in any business, but it's especially true in technology because the pace of change is so fast. A bad management team can destroy a great technology company in just a few years. The problem is, you can't tell from looking at a stock price whether management is actually good. In a bull market, everyone looks like a genius. Mediocre managers at mediocre companies get treated like visionaries because their stock price is going up. Investors confuse a rising stock price with good management. I've seen this play out countless times. A CEO gets lauded as a genius because the company's stock has gone up tenfold. People write books about their management philosophy. Business schools do case studies. Then the cycle turns, the stock falls, and suddenly everyone realizes the emperor had no clothes. The management was always mediocre. The stock was going up because of the bubble, not because of brilliant leadership. When I evaluate a tech company, I want to see evidence of rational capital allocation. Are they buying back stock at attractive prices or at peak valuations? Are they making sensible acquisitions or overpaying for growth? Are they investing in genuine long-term value creation or chasing short-term metrics that impress Wall Street? Most tech company management teams fail these tests. They're playing a game of keeping the stock price up by any means necessary. They make acquisitions that destroy value. They buy back stock at ridiculous prices. They manipulate metrics to make things look better than they are, and investors reward them for it because the stock keeps going up until it doesn't. And then everyone acts surprised that the brilliant CEO turned out to be just another promoter who got lucky during a bubble. Let me talk about a specific phenomenon that drives me crazy. It's this idea that tech companies should be valued on revenue multiples rather than earnings multiples. You hear people say things like, this company is trading at 10 times revenue, which is cheap for the sector. This is nonsense. Revenue is not profit. Revenue doesn't tell you anything about the economics of the business unless you also know the costs. A company with $1 billion in revenue might earn $200 million in profit, or it might lose $200 million. Those are completely different businesses that should have completely different valuations. Yet in the tech world, people routinely value companies based on revenue multiples, especially for companies that don't have earnings. They'll say, well, the company is losing money now, but once it scales, it will be profitable, maybe. Or maybe the unit economics are terrible and scaling just means losing more money on every transaction. I saw this in the dot-com bubble. Companies would talk about their path to profitability. They'd show these hockey stick charts where losses would continue for a few more years, then suddenly they'd become massively profitable. It was fantasy. Most of those companies never became profitable. They just burned through capital and died. We're seeing the same thing now. Companies go public despite having never made a profit. They're valued at billions of dollars based on revenue growth. Investors are making the same bet that the companies will eventually figure out how to make money. And in many cases, they won't. The smart move is to wait until a company has demonstrated that it can actually generate profit, then evaluate what those profits are worth. But that requires patience. And patience is in short supply when everyone else is getting rich buying unprofitable companies. Let me address the argument I hear most often in defense of high-tech valuations. People say that tech companies are growing much faster than traditional companies, so they deserve higher multiples. There's some truth to this. All else being equal, a faster-growing company is worth more than a slower-growing company, but all else is not equal. Faster growth often comes with higher risk. It often requires massive capital investment. It often attracts competition that eventually slows the growth. And most importantly, investors tend to overestimate how long the fast growth will continue. I've studied the history of business growth over decades. Here's what I've learned. Very few companies can sustain high growth rates for extended periods. The mathematics are against it. If a company grows at 30% per year, it doubles in size every 2.5 years. After 10 years, it's 17 times larger. After 20 years, it's 300 times larger. At some point, the growth has to slow. You run out of addressable market. You saturate your customer base. Competitors take share. The law of large numbers kicks in. It's inevitable. Yet investors pricing tech stocks today seem to assume that high growth will continue indefinitely. They're extrapolating current growth rates far into the future without thinking about the constraints. And they're paying prices that only make sense if those unrealistic growth assumptions pan out. This is how you get companies trading at price-to-sales ratios of 20 or 30 or more. Investors are assuming not just continued high growth, but also eventual high profitability, and also no meaningful competition. Stack enough optimistic assumptions on top of each other, and you can justify any price. But that doesn't make the price rational. I want to talk about something else that bothers me about tech stock valuations. It's the role of central banks and monetary policy. For over a decade, we've had near zero interest rates. This has pushed investors into riskier assets searching for yield. Tech stocks have been major beneficiaries of this trend. When interest rates are zero, future cash flows are worth more in present value terms. This mechanically increases the value of growth stocks relative to value stocks. It makes investors more willing to pay up for distant future profits because the discount rate is so low. But interest rates won't stay at zero forever. When rates rise, as they eventually must, the valuation math changes. Those distant future cash flows become worth less in present value terms, and stocks that were trading at 50 or 100 times earnings suddenly look very expensive. I've seen this movie before. In the late 1970s and early 80s, we had high inflation and high interest rates. Growth stocks got crushed. The Nifty 50, which were the blue chip growth stocks of that era, fell dramatically. Companies like Polaroid and Xerox, which had traded at 50 times earnings, fell 70 or 80%. When the cost of capital rises, valuations compress. It's not complicated. But investors today have been conditioned by more than a decade of low rates. They've forgotten or never learned what happens when rates rise. They're going to get a painful education. Now, I know what some people are thinking. Charlie, you're just a bitter old man who doesn't understand modern technology. You don't get that these are platform companies with network effects. You don't understand the power of data and artificial intelligence. You're stuck in the past. Let me respond to that. I understand network effects perfectly well. I understand that some tech platforms benefit from increasing returns to scale. I understand that data can be valuable. I'm not technologically illiterate. But understanding these concepts doesn't mean I should abandon basic valuation principles. Yes, network effects are real, but they're not infinite. At some point, you saturate the market. At some point, regulation steps in. At some point, a new platform comes along and disrupts the old one. Facebook seemed invincible, with billions of users locked into its network. Then TikTok came along and captured the attention of an entire generation. Networks can be disrupted. Data advantages can be replicated. Nothing is permanent in technology. The people who defend current tech valuations by invoking network effects and data moats, they're making the same mistake investors always make in bubbles. They're taking something that's genuinely valuable and extrapolating it to infinity. They're assuming that because a company has advantages today, it will have those advantages forever. History says otherwise. Let me tell you about my investment philosophy, because it's directly relevant to why I think tech stocks are overvalued. I want to buy businesses that I can understand, that have durable competitive advantages, that are run by honest and capable management, and that are trading at reasonable prices relative to their intrinsic value. Most tech stocks fail one or more of these tests. I can't understand many tech business models well enough to have confidence in my valuation. The competitive advantages often seem fragile to me. Management is often more focused on promoting the stock than on building long-term value, and the prices are anything but reasonable. So I don't buy them. I stick to businesses I understand, in industries I understand, at prices that make sense. Sometimes this means I miss opportunities. I missed Google. I missed Amazon. I've missed lots of things. But I've also avoided countless disasters by not buying things I didn't understand at prices that made no sense. I'd rather miss opportunities than make big mistakes. The most important rule in investing is don't lose money. The second rule is don't forget rule number 1. Buying overvalued stocks is a great way to violate both rules. Warren and I have made our fortunes by buying good businesses at fair prices and holding them for long periods. We didn't do it by chasing the hot stock of the day or by paying premium prices for growth. We did it through patient, disciplined, rational investing. And that approach has worked for us through every market environment over 7 decades. I see no reason to abandon that approach now just because everyone else is excited about tech stocks. In fact, the more excited everyone else gets, the more cautious I become. Crowds are usually wrong at extremes, and we're at an extreme right now with tech valuations. Let me make a prediction. I don't usually make predictions because the future is uncertain, but I'm confident enough in this one to go on record. Tech stocks are going to deliver disappointing returns over the next decade. They're not going to go up the way they have over the past decade. The mathematics don't work at these valuations. For tech stocks as a group to generate good returns from here, one of two things has to happen. Either earnings have to grow at extraordinary rates for many years, which is unlikely given the competitive dynamics and the law of large numbers, or multiples have to expand further, which is unlikely given that they're already at historically high levels. More likely, Earnings will grow at modest rates as competition intensifies and growth slows, and multiples will compress as interest rates rise and investors demand better value. That combination means poor stock returns and possibly negative returns. I'm not saying tech stocks will crash tomorrow. I don't know the timing. Bubbles can persist longer than rational people expect, but the direction is clear to me. These valuations are unsustainable. They're based on unrealistic assumptions. And when reality falls short of the assumptions, prices will adjust downward. Smart investors should be taking chips off the table, not adding to their positions. They should be looking for value in unloved sectors, not chasing momentum in overvalued tech stocks. They should be patient and disciplined, not greedy and speculative. But most investors won't do this. They'll keep buying because prices are going up. They'll convince themselves that this time is different. They'll rationalize paying absurd prices because they don't want to miss out. And they'll learn the same painful lesson that investors learn in every bubble. Price matters, valuation matters, and when you pay too much, you get poor returns. I've seen this cycle repeat throughout my career. In the 1960s, it was the Nifty 50. In the late 70s, it was oil stocks. In the late 90s, it was dot-com stocks. In the mid-2000s, it was real estate and financials. Each time, people convinced themselves the high prices were justified. Each time, they were wrong. Now, it's tech stocks. The story is different. The companies are different. The technology is different. But the pattern is the same. Excessive optimism, sky-high valuations, rationalizations for why normal rules don't apply, and eventual disappointment when reality intrudes. I'm too old to care about being popular. I'm too old to worry about what people think of my opinions. I'm just telling you what I see based on decades of experience. Tech stocks are overvalued. Most investors in tech stocks today are going to lose money. And the sooner people recognize this, the less they'll lose. Now, I'm not saying you should short tech stocks or bet against them. Shorting is dangerous. The market can stay irrational longer than you can stay solvent, as Keynes said. I'm just saying don't buy them at these prices. Don't add to positions. Don't convince yourself that you have to own tech stocks to participate in the future. There are other opportunities. There are other sectors trading at reasonable valuations. There are boring, unglamorous businesses that generate good cash flows and trade at single-digit price-to-earnings ratios. Those might not be exciting, but they're where the value is. And in the long run, value wins. It always has. It always will. You can ignore value for a while, and sometimes for a long while, but eventually prices return to value. The laws of economics reassert themselves, and the people who paid attention to fundamentals end up wealthier than the people who chase prices. This is one of the great truths of investing. It's been true for hundreds of years. It will be true for hundreds more. Price and value may diverge in the short term, but they converge in the long term. Gravity always wins. So when I say tech stocks are all overvalued, I'm making a statement about the relationship between current prices and underlying value. I'm saying the gap is too wide. I'm saying prices have gotten ahead of fundamentals. I'm saying investors are going to be disappointed. You can listen to me or not. Most people won't. They'll keep buying because the stocks keep going up. They'll tell themselves I'm wrong, that I'm out of touch, that I don't understand the new economy. They'll learn the hard way, the way people always do in bubbles. But some of you will listen. Some of you will recognize the wisdom in what I'm saying. Some of you will resist the siren song of easy money and overvalued tech stocks. And those of you who do will thank me in 5 or 10 years when you still have your capital intact and others are licking their wounds. Investing is not complicated. It's simple, but it's not easy. The simple part is understanding that you should buy good businesses at fair prices. The hard part is having the discipline to do that when everyone around you is doing something else. Right now, everyone is buying tech stocks at absurd prices. The disciplined move is to stay away. The smart move is to wait for better opportunities. The patient move is to let others learn the expensive lesson that overpriced assets deliver poor returns. I've been patient my whole life. I've waited for opportunities while others chased momentum. I've been willing to look stupid in the short term to avoid being stupid in the long term, and it's worked out rather well for me. I'm not going to change my approach now. I'm not going to start buying overvalued tech stocks because everyone else is. I'm going to stick with what's worked for 7 decades, and I'm going to watch from the sidelines as this bubble inflates further, knowing that it will eventually pop like all bubbles do. When it pops, and it will, don't say I didn't warn you. I'm telling you right now, clearly and directly, tech stocks are all overvalued. The people buying them at these prices are going to lose money. It's not a question of if, it's a question of when. The smart money is getting out, the dumb money is getting in. I know which side I want to be on. The question is, which side do you want to be on? Think about it carefully. Do your own analysis. Don't just follow the crowd. And remember that in investing, the crowd is usually wrong at extremes. We're at an extreme right now. Act accordingly. Let me spend a little more time on why I think the way I do, because understanding the mental models behind my thinking might help you avoid the mistakes I see others making with tech stocks. I'm a big believer in what I call worldly wisdom. That means learning the big ideas from multiple disciplines and using them as tools for thinking. When I look at tech stock valuations, I'm not just using financial analysis. I'm using psychology, history, mathematics, and basic common sense. From psychology, I understand that humans are prone to certain biases. We have a tendency toward social proof, meaning we think something must be right if everyone else is doing it. We have recency bias, meaning we assume recent trends will continue. We have overconfidence, meaning we think we're smarter than we actually are. All of these biases are on full display in the tech stock mania. People are buying because everyone else is buying. They're extrapolating recent gains into the future. They're convinced they can pick the winners and avoid the losers. These are classic psychological errors, and they lead to bad investment decisions. From history, I know that this exact pattern has repeated many times before. Every generation thinks they've discovered something new, some paradigm shift that changes everything, but it's never really different. Human nature doesn't change. The fundamentals of business don't change. And excessive valuations always, eventually, come back down to earth. In the 1630s, it was tulip bulbs in Holland. People paid absurd prices for tulips, convincing themselves that the bulbs were inherently valuable and prices would keep rising. Then the bubble popped and people lost everything. In the 1700s, it was the South Sea Company and the Mississippi Company. Same pattern, same result. In the 1920s, it was stocks in general. People bought on margin, prices soared, everyone thought they were geniuses. Then came 1929 and the Great Depression. More recently, it was dot-com stocks and then real estate. Each time, people thought it was different. Each time, they were wrong. The tech stock bubble we're in now is just the latest iteration of a very old story. The details are different, but the fundamentals are the same. People are paying prices that bear no relationship to value, and they're rationalizing it with stories about how this time is different. It's not different. It never is. From mathematics, I understand the power of compounding and the importance of not losing money. If you lose 50% of your capital, You need to make 100% just to get back to even. That's the arithmetic of loss. It's unforgiving when you buy overvalued stocks. You're setting yourself up for those kinds of losses. Maybe not immediately, but eventually. And when those losses come, they're very hard to recover from. The math works against you. Compare that to buying undervalued stocks. If you buy a stock at a substantial discount to its intrinsic value, you have a margin of safety. Even if you're wrong about some of your assumptions, you're still likely to make money because you paid a good price. But if you buy at a premium valuation, you have no margin of safety. Everything has to go right just to justify what you paid. I always want the mathematics working in my favor. I want situations where I can be wrong about some things and still make money. That's what value investing gives you. But with tech stocks at current prices, the math is working against you. You have to be right about almost everything to justify the prices. From basic common sense, I know that trees don't grow to the sky. No company can grow rapidly forever. No competitive advantage lasts forever. No business is immune to disruption or competition. These are just facts about the world. But the current valuations of tech stocks assume that these facts don't apply. They assume perpetual high growth, permanent competitive advantages, and no disruption. That's not common sense. That's fantasy. Let me give you some specific examples of what I mean. There are software companies trading at 20 or 30 times revenue. For that to make sense, they'd need to eventually convert a large percentage of that revenue to profit, maintain high margins, and continue growing for many years. That's asking a lot. In most industries, competition eventually drives margins down. That's what competition does. It benefits consumers at the expense of producers. The only companies that can maintain high margins are those with truly durable competitive advantages. And most companies, even successful ones, don't have advantages that are durable. I look at the history of technology leaders over the decades. Where's IBM now compared to the 1960s? Where's Microsoft compared to the late 90s? Where's Cisco compared to 2000? Where's Intel compared to their peak? These were all dominant companies that seemed invincible at the time, but their growth slowed, their margins compressed, and their stock prices reflected that reality. The same thing will happen to today's tech darlings. Some will fare better than others, but as a group, they won't live up to the expectations embedded in current prices. They can't. The math doesn't work. Another mental model I use is the concept of reversion to the mean. Over long periods, things tend to revert to average levels. Profit margins that are exceptionally high tend to come down as competition increases. Growth rates that are exceptionally high tend to slow as companies mature and markets saturate. Right now, many tech companies are enjoying margins and growth rates that are well above historical averages. Investors are pricing in the assumption that these exceptional conditions will persist, but mean reversion suggests they won't. Margins will compress, growth will slow, and returns will normalize. When that happens, and I believe it will, the stocks will have to adjust downward to reflect the new reality. The companies might still be good businesses. They might still be profitable and growing, but the stock prices will need to come down to align with more modest expectations. I've seen this pattern play out so many times in my career. A sector gets hot, valuations expand, everyone piles in, and then reality intrudes. Maybe it's increased competition, maybe it's regulatory pressure, maybe it's just the natural maturation of the business. Whatever the cause, the result is the same. The stocks underperform for years as expectations reset. That's what I expect to happen with tech stocks. Not a sudden crash, necessarily, though that's possible. More likely, a long period of underperformance as the underlying businesses grow, but the valuations compress. Either way, investors who bought at peak prices are going to be disappointed. You know what I find most frustrating about the current environment? It's that people have access to more information than ever before, yet they're making the same mistakes people have always made. They have decades of market history to learn from. They can study every bubble and crash. They can read about the psychological biases that lead to bad decisions. And yet they're still buying overvalued tech stocks. Why? Because information isn't enough. You also need wisdom. You need the temperament to act rationally, even when everyone around you is acting irrationally. You need the courage to stand apart from the crowd. And most people don't have that. It's much easier to go along with the crowd. There's social comfort in doing what everyone else is doing. If you buy tech stocks and they go down, well, everyone else lost money too, so you don't feel too bad. But if you avoid tech stocks and they keep going up, you feel like an idiot. You feel left out. You question yourself. This is exactly how bubbles persist and inflate. It's psychologically easier to be wrong with the crowd than to be right against it. But being right is more profitable than being comfortable. I'd rather be lonely and rich than popular and poor. I've spent my whole life being willing to be different. When others were chasing hot stocks, I was buying boring value stocks. When others were optimistic, I was skeptical. When others were scared, I was opportunistic. This contrarian approach has served me well. Right now, the contrarian position is to avoid tech stocks and focus on value. Most investors are doing the opposite. They're piling into expensive tech stocks and ignoring cheap value stocks. I think they're making a mistake, a big one, and time will prove me right. But I don't need everyone to agree with me. I don't need validation from the crowd. I just need to be right in the long run. And I'm confident that I am right about this. Tech stocks are overvalued, and investors who buy them at these prices will regret it. One more thing I want to address. Some people say that even if tech stocks are overvalued, you should still own them because they're the future. The world is going digital, they say, so you need to be invested in technology to participate in that growth. This is faulty logic. Yes, the world is going digital. Yes, technology is important, but that doesn't mean you should pay any price for tech stocks. The value of the technology doesn't automatically transfer to the value of the stocks. Think about railroads in the 19th century. Railroads were transformative technology. They changed commerce, travel, and society. They were absolutely the future. And yet, most investors in railroad stocks lost money. Why? Because there were too many railroads, too much competition, and the economics weren't good enough to justify the stock prices. The same thing happened with automobiles in the early 20th century. Cars were revolutionary technology. They were clearly the future. But most of the hundreds of car companies that existed went bankrupt. The industry was important, but that didn't make the stocks good investments at the prices people paid. Technology itself being important doesn't mean tech stocks are good investments. You still need to pay attention to valuation, competition, and economics. And right now, those factors all point to tech stocks being overvalued. If you want to participate in the digital future, fine, but do it intelligently. Wait for better prices. Look for companies with proven business models and reasonable valuations. Don't just buy expensive stocks because they're in the tech sector and assume you'll make money. I'm reminded of something Warren likes to say. The three most dangerous words in investing are "this time is different." Every bubble is accompanied by that phrase. People convince themselves that the old rules don't apply, that something fundamental has changed, that this time really is different. It's never different. Human nature is constant. Business fundamentals are constant. Math is constant. And the relationship between price and value is constant. Pay too much and you'll get poor returns. Pay too little and you'll get good returns. This has been true for centuries, and it will remain true. Tech enthusiasts who claim this time is different are fooling themselves. They're making the same mistake investors have made in every bubble throughout history, and they'll pay the same price. They'll lose money when the bubble pops and reality reasserts itself. I don't know exactly when that'll happen. Timing bubbles is nearly impossible. They can go on longer than seems rational, but I know it will happen eventually. It always does. And when it does, a lot of people are going to wish they'd listened to the old man from Omaha who told them tech stocks were overvalued. Let me end with this. I've had a good life and a good career. I've made a lot of money by following simple principles. Buy good businesses at fair prices. Be patient. Think long term. Avoid big mistakes. It's not complicated. I don't need to chase the latest fad to make money. I don't need to buy overvalued tech stocks to participate in economic growth. I can stick with what I know, what I understand, what makes sense, and I can sleep well at night knowing I'm not taking crazy risks. That's what I recommend to you. Stick with sensible investing. Avoid the mania in tech stocks. Be patient and disciplined. Look for value, not momentum. And remember that in the long run, fundamentals matter and price matters. Tech stocks are all overvalued. That's my view based on 70 years of investing experience. You can agree or disagree, but at least you know where I stand and why. Make your own decision. Just make sure it's based on analysis, not on emotion or fear of missing out. Good luck. You're going to need it if you're buying tech stocks at these prices.